Before we start, a brief disclaimer. This podcast is provided for general information and discussion purposes only and does not constitute investment advice, research, or financial promotion, nor an offer or solicitation to buy or sell any securities or financial instruments in any jurisdiction. The views expressed are those of the speakers at the time of recording and may not reflect the views of any organisation they are associated with. While information discussed is believed to be reliable, no representation or warranty is given, and no liability is accepted for any loss arising from reliance on it. Listeners should seek their own independent professional advice before making any investment or financial decisions.
I mean, gosh, it's a busy time in markets, kind of unprecedented, although we've said that in the past before as well, Dan. And really what I kind of want to focus on, if that's all right, is FX within the private markets asset classes. FX gets a lot of attention in public markets, but there's a lot of operational risk dynamics in private markets, which people don't tend to focus on, and they should. But before we kind of dive in, Dan, do you want to just kind of provide a little bit of background on yourself and Monex?
Sure. So Monex are a 40-year-old financial services business that is very much focused on the foreign exchange arena. In the last sort of 15 years or so, that kind of focus has switched, particularly in Europe, towards the private capital market space. Myself, I've been with Monex for 18 years now, so quite a
Well
long
done.
time, and I've spent the last 15 years or so really developing the company's offering towards the private capital market space. And what that really means for us is primarily alternative investment funds in the alternatives space. But really looking at trying to identify what the specific challenges are that are found within that space, and how do we solve for those. It's been perhaps a little bit more challenging because the traditional there's inertia, I think, from a lot of the people within private capital market space, particularly those that come from a banking background, and where either a lot of these services have been kind of provided for them under the umbrella of the banking world they came from, or there's a lack of understanding, and you kind of have to go through a process of education in order to get people up to speed with something that isn't necessarily their core speciality. So I think those two things, as well as trying to make sure that we're looking at targeting what are individual problems based around people's parameters and red lines, rather than just trying to push off the shelf solutions for a lot of these things, which the banks tend to have or the big banks tend to have a habit of doing.
Yeah. So within that context, what are kind of some of the misconceptions when we start engaging with clients who have kind of thought of FX as an afterthought, I would imagine?
Yeah, exactly that. I mean, if invariably it is often an afterthought, and it's one of the things where we have to kind of get people to try and think about it after the fact. The more beneficial kind of relationships that we have, quite often we have key relationships with people like fund admins, and who kind of bring us into the conversation earlier, which makes that easier. When people have treasury policies drafted before we get to the table, it becomes a little bit more difficult. But I think the challenges are that people think that it's either too expensive, they don't understand it, they have uncertainty over the time horizon that the hedges or the investments are going to be in place, and therefore don't know how to hedge it. Cash drag is something that is a significant has a significant impact on funds, and is a significant concern for people that are operating within this. So there's a couple of things where they feel like it's not, from an operational perspective, it's going to be too expensive, take too long, it's not going to match the profile of the underlying investment. And then there's kind of not having the skill set or the expertise internally to kind of manage this process as well.
Yeah. So we'll touch on some structural shifts in a little while, but can you kind of walk through how FX risk accumulates kind of over the life cycle of a private market fund? So capital calls, NAV distributions, exits.
Yeah. So there's a couple of different things. Obviously, depending on the size of the fund, they may have FX exposures kind of right at the beginning, in that you'll typically see the fund denominated in a particular currency. Let's say it's euros, if it's a Luxembourg or Irish based fund, which is quite often the case. But they then may have share classes that they operate in different currencies. So right from the outset, there is an exposure for those share classes going into the fund at the beginning. That tends to be more for the sort of the medium, to larger size funds that have that ability to market and then set up in different currency share classes. The smaller to medium sized funds, it may only be, that the fund is denominated in one currency, but has, a pan-European or global investment mandate, at which point they can start looking at doing deals in currencies outside of the base currency of the fund. And as you say, at that point, as soon as they do a deal, they have a capital call that they would look to, or it would be a good idea to hedge. Typically, and that's one of the kind of the easy way-ins, if you like, one of the things that we would always suggest that people look at doing, because typically, with a capital call, you sign your SPA or the or whatever it is, and you want to issue a call to your investors, but you don't know exactly how much you're going to need. So the typical strategy for a lot of people has been, we'll either overcall capital by 5%, 10%, whatever the case may be, or we'll just call the amount that we think we need and hope the market doesn't move in between. Either way, it's kind of capitally inefficient, and you end up in a position where either you've overcalled capital and then you've got excess cash sitting there causing a drag, or alternatively, worst case scenario, the market moves significantly against you in that period, and you have to issue another call to your investors to meet that commitment, or find another source of liquidity to be able to meet that liquidity gap. So whether that's a subscription line or a revolver or whatever else. We typically also see in that early stage, if people aren't using, they may be using a subscription line, for example, to make investments, either from the purpose that they have, they're looking at that as a way of maximizing returns, or alternatively, they only want to make, I don't know, one call or per quarter to their investor base, for example. So they'll maximize their subscription line before they sort of pay that down. But again, that just is an extension really of the capital call period. So rather than making that a 10-day hedge, for example, that could be then like a 3-month hedge. So that's kind of at the beginning of the cycle, when they have that, when they're making the investment. Clearly, through the life of the hedge, there is a balance sheet exposure for that asset that sits on the balance sheet in a different currency. And it's a question as to whether the fund wants that macro exposure to that currency, or whether they want pure performance of the underlying asset and therefore want to hedge that risk out for however long that period is. And obviously, you have the same problem in reverse, when they exit, in a different currency and have to return distributions back to the fund and to the investors. Clearly, depending on the type of fund, there might be ongoing income streams in different currencies. So in private credit, you would see coupons, for example. If it's real estate, you might have rental income. Private equity, you might have, dividends that are being paid. Depending on what you have certainty over, you can hedge out those things as well, because they have an impact, but typically not as much as you would see as the movement on the underlying FX on the principal.
Yeah. I mean, I find it fascinating, almost from a psychology perspective. So in kind of public liquid markets, everyone's always on top of FX, right? So net return, right?
Yeah.
Private markets, by its nature, it's buy and hold, longer holding periods, and illiquid. and everyone kind of forgets about the FX component. And so I just kind of look at boards of the funds and the oversight and governance. Um, and from your perspective, what would be the one FX risk that every board or committee member of a GP should be focused on? What has the biggest impact, or is it just situational?
Um, I think it is situational, and I think um, it depends on. There's a couple of different things that come into play. One is kind of um, the how much certainty over what your exposure is going to be in the longer term. So, as an example, you would have much more certainty if you were in private credit, for example, than if you were in private equity or real estate, because the gains or losses on your principal, plus the coupons are more known than than what they would be within private equity, for example. Um, but I think in terms of what has the biggest impact, certainly hedging the balance sheet risk on the principal is what has the biggest impact, because over the longer term, if we see bigger market moves, then if you, particularly in the lower yielding asset classes like infrastructure, for example, where you might be seeing, longer term returns of, 8-10%, for example, uh, you could easily see a move of that magnitude in FX over a couple of years. So I think, structurally having an understanding of what that move could look like against, what your returns profile is, I think is really, really important. And I don't think people kind of take that into consideration perhaps as much as they should do.
Yeah. So, I mean, you work with a number of different intermediaries in the market. So, fund management, custodians, ManCos. So, how do you work with these different kind of relationships in the marketplace? What's your kind of approach?
Uh, it really depends on what people are looking for. We have a business development team that goes out and pushes our services to these companies, but most of the reason that we have in lots of cases exclusive partnerships is because people have gone around the market, and they've had experience with other providers in the market, and their experience hasn't been great, and they're looking for a partner that's kind of is well established, well trusted, strong balance sheet, good reputation within the industry. And thankfully we have all of those things. So uh, it's really a combination of us kind of actively building those relationships and partnerships with the types of entities that you're talking about, or it's them coming to us because they've heard good things from individual clients that we work to, because a lot of these, well, oftentimes the we would come to a relationship through an individual client. So our BDU will go out, they'll reach out to individual fund managers or whatever, and the fund manager will then instruct their fund admin or their manco or whoever it is to engage with us. At that point, as soon as that conversation starts, the question invariably comes, who else do you look after who has this problem? And we kind of go full circle. So it becomes something where there's reciprocity on both sides.
So, I mean, there's a lot of change in the market, and I'm going to bring it up, Dan, and it's not a topic I usually like to talk about because it's a bit, from my perspective, over marketed. But stable coins introduced into the marketplace. What are your thoughts on stable coins and where they fit?
Um, it's interesting because I think in theory they're great, and they would solve for certain challenges that are faced within the market. In practice, they don't really work yet. Um, so, as a good example, one of the things that stablecoins would allow markets to do would be kind of instant transfer of funds without having to go through intermediary banks and the usual kind of payment rails that are needed for everything else. Which means that instant verification of funds for for transaction purposes, whether they need to be at a particular in a particular account or at a time and place, in order to meet the closing requirements of a particular deal. Same with posting margin or collateral, for people who are trading on exchange. Those things can happen instantly, be verified instantly, allowing people to either not have positions closed out if they're variation margin calls, for example, or allow people to trade much faster in fast moving markets. So that type of thing, I think there's definitely a benefit for. What doesn't change is that it doesn't necessarily change price discovery within the market, in that there's still going to be somebody who is making a market for those things and somebody that's taking a spread on those things. And at the minute, these markets are a lot less liquid than foreign exchange, which is the most liquid market in the world, with something like $75 trillion traded on on an annual basis, or whatever it is. It's enormous, and therefore the market is very transparent, and price discovery is very accessible to anybody. Whereas with stable coins, much less so. Liquidity pools much shallower. So it's, in theory, like, it's a great idea. In practice, it doesn't work. And you also have the issue of regulation as well, and the regulation and oversight that you don't have, or that you have in FX markets, within kind of the framework of financial services regulators globally. But you don't yet have kind of either regulators necessarily who are prepared to adopt these in quite the same way, or a general oversight framework that you would have for stable coins that exists, within FX or currency at the minute. So yeah, I mean, like I said, in theory, it's great, solves for some challenges, doesn't solve for others. Until it's kind of taken over and broadly accepted by more people, you won't get people that are investing in the infrastructure that is needed to create the stability and give, regulatory oversight and whatever else. So it's a little bit of a chicken and egg problem, in that, one requires the other in order for it to get to a level where it's going to be comparable. And maybe that happens with the help of AI, as everything seems to at the minute. Who knows? Uh, but for the time being, I don't see it kind of materially changing the way that we operate right now, or at least for the next 18, 24 months for sure. And there are developments that I'm aware of that are happening within the banking world for payment rails and various other things, where we are already seeing kind of more instantaneous transfers, where people are using blockchain technology, for example, in order to be able to transfer funds on a more instantaneous in a more instantaneous manner, but still using traditional currency, but using blockchain technology in order to facilitate that. So I think that's perhaps a more likely step, if you like, perhaps, rather than stable coins themselves. But we'll see. Time will tell.
Right. So then we'll finish up in a second here. But if I'm on an investment committee, I'm a GP. I understand your approach, kind of the consultative approach of having conversations early, putting governance and frameworks in place. What do you give as a suggestion to GPs on engaging on the topic of foreign exchange in their overall governance and program that they're running for their LPs ultimately?
I think, thankfully, from our perspective, it's something where we perhaps have to have less of an input now, in terms of getting people to think about it, precisely because investors are asking more of those questions now than perhaps ever before. And that's a combination of FX markets being, particularly volatile over the course of the last 5 or 10 years, people having their fingers burnt by big market moves, awareness of the geopolitical situation and the increased likelihood of black swan events, where we've seen double-digit percentage market moves in currency in short spaces of time, and we've had a number of those even in the last few years, with COVID and Mr. Trump's election, and various other things. But as a result of these, investors are asking the questions and they want people to have at least thought about it. So people are coming to us, and our job is to turn around and say, well, explain to us what your investment strategy is. Let us know, what the profile of, or your returns profile looks like, or your IRR. Tell us where the specific risks sit in terms of, what is your allocation to foreign currency out of the base currency of your fund. So I'm being able to understand what is the material risk, to the underlying fund from big currency moves. And once we've done that, establishing where people's red lines are in terms of, what is the goal of the hedging strategy, first of all, and secondly, what are the things that we really can't do? So is there a finite amount of capital that you can call? Do you have access to any additional liquidity that can support hedging? If you're, a liquid or semi-liquid fund, for example, are there any gated liquidity events that we need to be aware of if you're, a UCITS fund, for example, or something like that? So there are a whole load of kind of clarifying questions that we would kind of go through in this consultative process to understand what people are trying to achieve. But ultimately, then, come back to people with, a range of solutions and say, these are the different things that you can do. And a lot of it depends on what is your own appetite to risk, what is the goal of the hedging strategy. And once you've done that, then we can slowly fine tune, what it is that people are looking to achieve. The kind of sad thing that we always try and kind of have to deal with, there's two things. One is to hedge or not to hedge, is the perennial question as to what constitutes speculation or not. And people sit on both sides of the coin, where you can say doing nothing is speculating or doing something is speculating, because you're drawing a line in the sand. So that's always a difficult conversation to have. And I think it's the one. I suppose it's the one that is the most challenging to kind of get over if people have got a fixed idea as to whether that's something they should do or not. And cost is the other thing. It's whether, because there is an underlying cost to this, and unfortunately there isn't a silver bullet. Everyone wants to be able to put hedging in place, have no impact of currency, have no kind of cost of credit or whatever, to put these facilities in place to support that. Don't want the impact of carry, of the forward curve if it's against them. But unfortunately, these are all things that you can have, and people want to have those things, and they want it for nothing. So there has to be an understanding that if you want to hedge currency risk, it comes at a cost. That's the first thing, and you have to be prepared that to miss out on the gains, quote unquote, that you might not achieve if the currency moves in your favor. But that's the point of having something in place, is that you take your risk off the table rather than leaving it there. But
Well, to your point of having the conversations early, I see way too many times people forget about foreign exchange as they start operating, and then go, "Oops, didn't think about that."
Yeah.
So early bird
Absolutely.
gets the worm. So listen, thanks for the conversation. You're having a baby at any moment now, so congratulations. Hope it goes well.
Thank you very much.
And listen, we'll have a follow-up conversation, because there's areas around private markets into retail channels, the complications around that and around risks. We can have another conversation. Lots to talk about. But thanks for your
For
time.
sure. Yeah. Thank you very much. Pleasure being here. Thank you for having me.
All right, cheers.
Take care. Bye bye.